Good morning, good evening, good night. We're watching this transmission. It is I, Mike Martins. Welcome to a special edition. I want to try maybe a new series, see how it goes. Can't read market talk. It is I, Mike Martins. I can't read. But let's talk about the markets. And remember, guys, do not take any of my advice. Do not take anything I say seriously. Do your own research. You have Google. You have many ways to find. You have Yahoo Finance. You have a lot of ways to do your own research and your own due diligence. And remember what G.I. Joe used to say, and knowing is half the battle. Intelligence is halfway there. Anyways, guys, broadcasting from Merritt, British Columbia. Beautiful sunny day. It's going to reach 30 centigrade today, so it's going to be a pretty warm day. And we got quite a few things lined up here for today, so let's kick it off. Before we kick off, let's talk about the S&P and TSX sitting at 16,258, down 50.53 points. S&P 500, that's one to look at right now. It is down 3.25 points. 2,921. The Dow Jones is sitting above 26,256, up 54 points. Canadian dollar is taking a small hiccup today at 75 cents to the US dollar. Crude oil, it's at 55.33. I'm going to discuss what's going on with crude oil. Bitcoin and Canadian dollar is below the 10,000 US mark. Gold still sitting above 1,500. Will we see a $1,600 gold mark by Christmas? The Russell 2000, that's a very important market to keep an eye on. It is down 5.0 points, sitting at 1,504. 10-year bond, whoa! Whoa! The 10-year bond is at 1.60. Woo! Wow, that was at 1.5 the other day. Wow, I see bonds going to zero, but NASDAQ, 7,981, down 74 points. Volatility looking good, and the FTSE is down 75.79. All right, guys, that's from our friends over at Yahoo Finance. So let's move over here to this one. Facebook unveils results of its new conservative bias audit. Yeah, I'm not even going to read it because I don't care. And they're adjusting enforcement of policy to focus prohibiting ads only when ads shows someone in visible pain or distress where blood and bruising is visible, the report said. Facebook, they're going to start chipping away. It's a chip away. It's basically like when Michelangelo created some of those beautiful statues. He would look at it for days before he'd chip away at it and eventually chip away until he got his final product. But with Facebook, people are just going to jump ship. Nobody cares anymore. This is a very important. Fed's regional presidents lining up against additional rate cuts. So we know they're going to be cutting rates even though we are in a booming market. So what's there to boom? I don't know. Bloomberg, terms of trade and daily newsletter that untangles the world embroiled in trade wars. Federal Reserve policymakers voiced their resistance to the notion of the U.S. economy needs lower interest rates, foreshadowing a sharp debate at central bank's meeting next month with officials who won't cut again. So they're trying to find clever ways to lower rates. They're trying to find a way to weasel it in. Weasel. It's weasel. It's not weasel. Weasel. Chairman Jerome Powell could provide more guidance when he speaks on Friday. Okay, well, we'll look forward to that on Friday, and we'll cover it here. Minutes of the July policy meeting published Wednesday revealed Fed officials were split over the need to cut rates. The decision pitted policymakers concerned about trade conflicts, showing global growth, too low inflation, against those who saw strong U.S. economic data and indication that businesses and consumers are powering through the latest uncertainties. The minute said several officials favored keeping rates on hold. Yeah, I think I would keep it on hold and raise them a few points before doing this, because if you were in an economic boom and there are jobs, I would, yeah. So oil's taking a beating after this report this morning. U.S. to drown the world in oil. So what is the attempt by this? What is the motive by this? Well, obviously, it all points to the Middle East and the Middle East undertaking. The U.S. could drown the world in oil over the next decade, which, according to a global witness, would spell disaster for the world's attempts to address climate change. So, we know what the narrative is here. Let's throw in climate change and get people to rally behind it, but in reality, it's just going to drop the oil markets and bring the petrodollar. It's going to lower the petrodollar, but not only that, oil will be cheaper. And if it's not being, I think it's $90 or $97 a barrel, they're taking a loss. So a lot of oil companies are producing at a massive loss. So yeah, throw climate change in there, maybe some global warming and maybe a little bit of, who knows, like, I'm not going to say this because I'm not going to say what I want to say because it's going to flag my channel. But the U.S. is set to account for 61% of the new oil and gas production over the next decade. A recent report from this organization said to avoid the worst effects of climate change, we can't afford to drill up any oil and gas from new fields anymore in the world. This, of course, world would quickly cause a global deficit and world countries to consume around 100 million barrels per day, BPDs, of oil. Global Witness notes that the industry is not slowing down in the United States, notwithstanding recent spending cuts by the independent and financially strapped oil gas firms. If anything, the consolidation in the Permian and other shale basins increasingly led the oil majors, ensuring that drilling will continue at a steady pace for years to come. So yes, it will, and it is going to break down the oil. The oil and the energy sector is in automatic breakdown as we speak. The oil sector and energy sector will start to break down. And oil falls, U.S. factory slowdown, Royals concerns about demand. Oil dropped after a week of manufacturing data exuberates concerns about the global energy demand. So, futures fell as much as 1.1% in New York on Thursday, whipping out earlier gains. A key gauge of industrial activity in the world's largest economy declined for the first time in almost a decade. Meanwhile, the U.S. Federal Reserve Bank president threw cold water on the expectations of an imminent interest rate cut. So that's an oil boom that everybody jumped on a few days ago and messaged me and said, oil looks like it's ready to take off. I'm sorry, guys. And what's going on? Remember, guys, this is the Can't Read Market Talk, but we need to discuss, right? I have a grade 6 reading level, but we need to discuss. Okay, let's discuss, guys. Sorry about my audio, guys. My audio is all over the place. I'm trying to get it fixed. I'm not sure what to do, guys. So I'm going to have to buy another mic. The problem is I spent $200-$300 on a mic, and I'm going to have to buy another mic. You know what I'm saying? It's sounds like tropical radio here. Okay, they're not looking at the data. Analysts brace for German recession and sentiment turns dire. So what's going to happen is they're going to start bailing out Bundes and Deutsche and all these banks because they're too big to fail. So if they're why are the taxpayers having to pay for this? Why are they going to have to flip the bill? I never understood. If they're too big to fail, let them, like the Titanic, it's too big to fail. Well, it failed, and there was no one there to rescue it or bail it out, or bail out the water, but still, there was some good at some not so good news in today's German PMI meeting. The good. The composite PMI rose 0.5 points to 51.4, beating expectations of another decline, and led by the modest gains of manufacturing output and subcomponent, even after services PMI showed marginal decline. However, the underlying indicates were more subdued, with new orders and employment falling more. The press release also noted that a sharp fall in business expectations in the services sector, blockages of work across both sectors fell from 10th month, and the pace hiring slowed, with employment in manufacturing declining at the fastest pace in 7 years. Perhaps more concerning was the outlook, which is now outright recessionary. As for the first time since 2014, more companies now expect output to fall than rise over the next 12 months. Yeah. So there's the German GDP. So right now, it is definitely not in a good position. Let me full screen that for you guys to see this at home. And for radio and listeners, It's right at 0.1% sitting at the GDP, so they're in negative growth right now. That means a shrinking economy, guys. That means shrinking everything, shrinking jobs. That means it's a problem for Germany. The president German weakness driven by mounting global trade tensions, car industry woes slowing down demand in China certainly does not bode well for the broader euro area. The silver lining, whereas European manufacturing is now screaming recession, at least services remain well in expansionary territory. Remember, most of Canada is now completely service industry, right? It's built off people's debt. The industry is built off debt, loans, student loans, and after student loans went federal, that's been helping the Canadian economy, right? However, with the spread now of all-time highs, it's now a matter of time before services tumble. However, commenting on the latest dismal data from German Bloomberg's chief European economist showed a trace of optimists, saying that there's a little light at the end of the tunnel in the German's economy. Yeah, the light of escaping the German economy, or escaping where you are in Germany to get away. No need right now. Bundes pours cold water on German fiscal stimulus hopes. One of the pillars of support has helped to propel the European stocks higher in recent days, with violently yanked this morning. The Bloomberg reported that Germany's Bundesbank repeated trial balloons by Spiegel, saying it doesn't see the need for fiscal stimulus at this time, even though it expects the economy to shrink again this quarter. Yeah, the economy is going to be shrinking for the next 5 to 6 quarters, guys. So, however, just like Trump, the German central bank refuses to accept the true extent of the economic slowdown, and instead, experts there describe the state of the economy as protracted stagnation, with the performance over the past year skewed by the range of temporary factors. A mild winter weather, for example, boosted the output of the first quarter with payback in spring. Guys, Germany is hoping and praying to be like a Japan, stagnation, kind of not move, no growth, just kind of sit idle. But no, the difference is that Germany is in massive debt, right? And Germany needs the European Union to continue, right? With austerity measures all over Europe and Germany controlling the European Union banks, it's going to be tough when countries start breaking apart with Brexit, and then now reports of Italy, Greece leaving the EU and saying, you know what, hasta la vista, we have these borders in place for centuries for a reason. China partially lifts restrictions on gold imports. Why? Well, you know what? China wants more gold. And China's gold imports tumbled May to June. So they're going to lift restrictions to let more gold into China. Why? Because China is buying up gold like crazy. And it's not just the Chinese government, but the people are now waking up to gold. And I was speaking to somebody in Beijing that told me that gold shops and gold dealers are basically selling out of gold everywhere. Why? Because they want to jump the yuan. They want to jump the Chinese dollar, the yuan, whatever you want to call it. They want to get rid of it. They want to unload into gold and silver. So last week's surprising report emerged from Reuters, namely that the part of its escalating capital controls, Chinese authorities have curbed private gold imports. Since May, the trade war escalated in a move that could be aimed at curbing outflows of dollars and bolstering its yuan. According to sources, China's gold imports were down 300 to 500 tons, around 15 to 25 billion. Since May, the PBOC had several months curtailed or not granted import quotas commercial banks responsible for most of their gold that enters the country. Fast forward to today when Reuters reports that China has partially lifted restrictions of imports of gold, according to the bullion industry sources. According to the report, the central bank began to issue quotas again last week, but for lower amounts of gold considered normal. 3 people with direct knowledge of the matter in London, Asia said, without specifying exact amounts. China has become a key swing driver in gold prices. It is now the world's biggest importer of gold, with around 1,500 tons of metal worth some 60 billion, equivalent to 1/3 of the total supply entering the country last year. Chinese demand for gold, jewelry, investment bars, coins have trebled in the last 2 decades as the country has rapidly become wealthier. China's official gold reserves, meanwhile, rose fivefold, nearly 2,000 tons, according to the official data. The recent sharp move higher in gold coincide with the sharp escalation in the currency between the U.S. and China, prompting many to speculate that Chinese residents had been aggressively buying up the yellow metal in the process of adding further downturn to pressure of the yuan. So, guys, they're buying up the metal. They're buying it up in China. So I've had a discussion with someone in Beijing, and they told me straight up, you're right, Mike. A lot of the small gold dealers can't keep any gold in stock. They are charging anywhere from 2 to 500 US dollars above spot. So people are even paying more than the value of what gold is worth just to get their hands on it. And I see it happening just like happened to the housing market, where the Chinese were parking their money in Western countries, and like cities like Vancouver, Sydney, Melbourne, Los Angeles, Beverly Hills, like all over, Seattle, Portland, all over the place, Auckland, London, and they've been parking their money in real estate. Now that they're having a really tough time getting their money offshore with the new Chinese restrictions, a lot of Chinese have been buying gold and gold reserves and reserving and saving gold, even at home, even in gold, just stacks in safety deposit boxes. So that is very important that the gold market might start even rallying even harder because of the lack of the yellow metal. And with people in Germany and other countries, Germany and Deutsche Bank, of course, I don't want to pick on them, but people bringing in their gold certificates that they bought 5-10 years ago, that bought gold at 900, 1,000 an ounce, and saying, okay, I'm here for my certificate, I want my physical gold. Oh, we'll mail it to you. And no one's receiving it in the mail. It's turning out to a nightmare. The media is doing a really good job hiding that. I don't know why. It's been happening since 2012. So, retail apocalypse closing. Here's how 20 retailers have affected the Harrisburg area. Now, it's not just Harrisburg, because the stores that are closing, this is an article from today, they are closing, and the Gap closing stores, Gymboree closing stores, Radial Scrap, those guys are gone, I think, Payless, Body Central, Plus, The Limited, Sears, Toys R Us, Claire's, Crazy Eights, Finish Line, GNC, The Bonton, Aristotle, Deb Shops, Hollister, PacSun, Read More. I can't read, guys. You are listening to Can't Read Market Talk with Mike Martins. All right, let's move on. Now, 2019 has been full of Canadian store closures. It's been a tough year for Canadian retailers who said goodbye to Payless and Shoe Source and Town Shoes and all the other places here. Canadian stores that closed. So this is just a video here. I don't want to play it so I don't get flagged. This is from Huffington Post. So more Canadian stores closing. Now, I want to close off today with this very important article. I need you guys to read this, okay, guys? The article's called Why Junior Miners Will Be the Biggest Winning in the Coming Gold Boom. In the coming gold boom, gold. Yeah, not bad for a guy that can't read, eh? But anyways, pay close attention. What happens when the world's biggest miners run out of gold? Well, we already know. We've already hit peak gold, and with only companies sitting on promising new reserves, the junior miners. The big miners are scrambling for more gold, and the merger has taken hold. Large cap miners are doing three things to record pace. They're merging with other major miners. They're scooping up juniors sitting on the best patches of gold, and they're conducting a series of micro deals to gradually insert themselves in the junior miner patch. I'm not going to say much more about this. I ask, there's about a bunch of tickers here, guys. Okay? I ask that you guys pay very close attention to what I'm reading here, please. And these gold patches might be the thing of the future. I'm not allowed to give financial advice and I don't want to give out financial advice because it is illegal to. But I do want you guys to please read this article. I'm going to go back to it for you guys. It is called Why Junior Miners Will Be the Biggest Winner in the Coming Gold Boom. All I'm asking, it's from 3 days ago, is to read the article. And you make your judgment on your call. And guys, don't forget, guys, if you want to support this transmission, don't forget to support me on Patreon. $1 a month. There's a Patreon link here at the end of the video. And also, don't forget to get to my channel. Please get to my channel. And I ask that you just share one of my videos. Go on and share one of my videos. Let me know what you guys think on what is happening. This is Mike Martins from broadcasting from Merritt, British Columbia for Can't Read Market Talk. Thanks for watching, and don't forget to hit the subscribe button, and looking forward to your comments below. Thank you.